Hey, welcome to our nuts and bolts session on financing sources. I'm going to give a little overview of some things to help set the stage, then we'll have a panel, and I'll introduce the moderator of the panel, who can then introduce the rest of the panel. So let's start off with the overview. For those of you who were looking at the homework assignment, there is a video from the Kauffman Foundation about where companies get money. I'm not going to play it here, but if you haven't, you should check that out. I want to give an overview of financing sources. Tonight, we're going to be looking at investors who invest directly. There'll be angels, venture capital, corporate VC. That's our panel. But as an entrepreneur, there are other ways you can get resources, and here are some of them. And you've seen these before: Kickstarters, where you can get money for a product. Crowdsourcing, which is a form of perhaps we can even talk about it on the panel, whether you, as later stage investors, you like to see or don't like to see crowdsourcing. SBIR, that's Small Business Innovation Research Grants from 11 or so federal agencies. That program is in sort of in a pause right now while they try to figure out what it's going to look like next year. But those are grants that are phase 1, phase 2, and phase 3 grants, where in some cases you can get up to several $1 million. A classic for getting resources is starting a business as a consulting. You consult with somebody who is you think you have some skill with, you learn what their problems are, and you decide, gee, I think I'll build a solution to that. And the issue there is you can get paid nicely while you're consulting, but how do you switch to a product company? That's an interesting transition, but a classic way. While you're consulting for them, the other way is getting, as part of that deal, NRE, non-recurring engineering, which is a way of getting some upfront payments instead for a project. From an accounting viewpoint, if you're licensing something, advance against royalty. One of the issues that large companies have, public companies, where they're relying on their earnings and their price-earnings ratio to set the stock price, is if they spend money on R&D, it gets expensed. There's a bunch of rules, but essentially it goes and reduces their profitability. On the other hand, if they buy your company, because you've already de-risked it and you've shown that they're customers, that goes on the balance sheet, and it doesn't hit the income statement. That's sort of why I call venture capital as sort of an outsourced R&D. You give the venture people the job of getting the companies to a point, and then they bring it back in. And of course, entrepreneurship, competition prizes are another ways. There are other versions of that, like Y Combinator, incubators, accelerators, sometimes provide funding, some for actual ownership and some not. So that's sort of a big list, and maybe there are others that the panel will point to. Just some definitions. Pre-seed stage is sort of the ideation phase where you maybe have an idea, maybe some basic idea of what you're doing. Seed stage is when you're taking and trying to figure out, is this something that's going to have value and with whom? And then you move to early stage where you're actually ready to start launching. And it's where you're trying to get to viability. Then you have expansion stage. This is where you're starting to actually build the product, scale it. And then later stage, where you're really trying to, by this time you should be probably profitable in the normal world. That doesn't seem to happen in the AI world these days. But those are definitions, and I put them there because I wanted to give you some data on what the world looks like in 2025. This is taken from the pitch book and the National Venture Capital Association Venture Monitor. It comes out quarterly. You can actually get copies of it. Before I show you the valuations, the amount raised at the different stages, just some observations about the financing environment. The IPO market's been pretty slow over the last year, which means there are fewer exits. And I think, John, you mentioned something about that. That means more companies are being funded privately. So some of the numbers I'm going to show you may indicate that companies are staying private longer, and therefore the amounts raised, et cetera. And as they say private, some of the unicorn market, the valuation I saw was 3.7 trillion now in unicorns. And there's huge dollar investments across all stages in AI, as you know, unless you've been living under a rock somewhere. It's a very hot market for financing. So with that background, let me just run through these quickly. This is 2025 data that I showed the numbers on. That's the chart over the last, 10 years? And you can see the blue bars are the deal value. That it means the amount of dollars invested in pre-seed and seed. And the number of deals are the blue line. And if you do the math in 2025, the seed stage deals, there were about $20.4 billion invested. This data is was published on the January 16th, I think. If you do the math, it turns out the average deal size in 2025 would be roughly 5.4 million. Interestingly enough, if you go back to 2020, if you can see it on the chart there, it was about half in both accounts. It was about half as much invested, and the deal side was about half as much. The pre-seed value, there was about $1 billion, $900 million, with the average size of 960,000. Now, they break out separate data for angels, so there may be overlap between these, but the angel world, according to PitchBook, was about 600 million invested with an average deal size of $590,000. The reason I told you to look at what the environment was like, you can picture some of these getting skewed because of money going into AI type things. If you look at early stage VCs, similar type thing happening here. What do we have? $67 billion with an average deal size of about 11 million. And again, if you go back to 2020, you'll see it's about half to two-thirds in 2020 as it was this past year. And I looked at the CVC, corporate venture capital participation. This one's a little hard to really understand. Often corporate venture will come in later in a deal. Therefore, there'll be bigger checks because later on there's more money being raised, although there's some corporate ventures that go in early in the process. But here's the deal size was about $70 million. Now, this sort of shows you what's happening by sector. Again, if you look at 2020 at the bottom, the red line versus 2025, that's software. I think most of that is probably AI. There's less investing in regular software. And proportionally, you can see that the pharmaceuticals, which are the red slash bars, are proportionally less. So it's all by way of saying these will change as the financing cycles change, as the markets change, as interest rates go up or down, as there are a number of funds that are sort of locked in the sense that they don't have exits, and that creates issues for LPs investing in the next round. I'm sure we'll go into that a bit in the panel. Which brings us to the panel. John Harthorne is a moderator who put together the panel. John John was Sloan. I met him when you were on the Global Startup Workshop, was it? And then he went off and decided after going out in the consulting world for a year or so that maybe the better things to do were to figure out how to do more startups. So he started this thing called Mass Challenge. You probably haven't heard of it. It's only the largest thing of its type in the world. With I'm not sure where all the offices are, all over the world at this point. So John, if you come up and maybe then we can introduce your panel. Okay.
How's that? Can you guys hear me on the mic? There we go.
Okay. Great. I'm just going to leave that up there so they can identify. Yep.
Thank you. All right. Good to see everybody. Thanks for coming out on this snowy New England day. And thanks to all of you online for joining us as well. My name is John Harthorne, as Joe mentioned. I, right now, am the managing director of a fund called Two Lanterns Venture Capital. We have two funds going. We invest at the pre-seed and seed stage, back to the stages as Joe gave you the overview. So very early, the earliest money in, and then the next earliest, essentially. And we focus on software AI startups in the US and Israel. Our Fund 1, we made 36 investments, and we finished up towards the end of 2024. And then we started fundraising and investing out of Fund 2. We made 6 investments out of Fund 2 across 2025. We've got some lined up coming up soon. I'm going to have everybody introduce themselves in a minute and give the similar types of information about their fund. Prior to launching the fund, I was, as Joe noted, the founder and CEO of Mass Challenge for about a decade. And then before that, I was at Bain & Company, and before that at Sloan 2007. And then before that at a couple of different startups and small businesses, mostly in kind of junior roles, figuring out what I was good at. As an investor, I would say, so because we are very early stage, it is hard to leverage metrics to make decisions, right? When you're a much later stage investor, if you're looking at a public company, it's very easy to look at, do they have a dividend? How much revenue do they have? What was their growth? You know, how much does it cost for them to acquire companies? How much are they spending on R&D? There's a lot of numbers, and the market has a size and has a predictable growth rate. It's more formulaic to make a decision about those later stage companies. And that carries through into venture at the much later stages, Series C, Series D, Series E, just before IPO. But as you get earlier and earlier at pre-seed, it's often 3 people in their basement with an idea. And if it's a good idea, it's a new idea. So that means that market doesn't even really exist. There's no size to that market. You know, how big is vibe coding? I don't know. Like now it feels like it's real, right? That we can say, but 3 years ago, it didn't. And so that was like a made up concept. And then you have to make investments. So instead, we are mostly focused on the quality of the team. That's like 70% of our decision is based on the quality of the team. And that has many different layers to it. But a lot of it comes down to their ambition, a history of success, the passion about their idea, integrity, their ability to express themselves, and whether we believe if we put them in front of other people, they will be able to sell those other people on the idea, other investors, customers, team members. So there's a whole bunch of attributes of that team that we look for. That's about 70% of the decision. Then about 20% is the market, and that's our assessment of either the existing size or its growth potential in the near term, and also the competitive dynamics. If it's already dominated by one massively funded company, then that's maybe more difficult. If it's fragmented, there's still more room to gain share. So just the dynamics of the market, what types of customers, how easy is it to approach them, how long are the sales cycles, all of those types of elements around the market itself. And then that's about 20%. And then the last 10% is the product traction, the specifics. And it's only 10%. People think that should be 90%, but it's only 10% because that is like the only thing you know with certainty about an early stage business plan is that it is wrong, right? So they are going to pivot multiple times, and they're going to redesign their business model. So their exact pricing strategy, probably not right. Their exact customer segment, probably not right. The exact details of the product and features, probably not right at the very early stage. So we look to see that it makes sense, it's coherent, they can build something, they're competent, but we don't care too much about the specifics and the details, because probably that will change. So 70, 20, 10, those are kind of our key metrics. And then geographically, all across the US, and Israel is the only international place that we invest. So let me ask you guys each to give similar kind of info, individual background, a little bit about your firm, fund, high-level focus areas, and then if there's a specific set of criteria that you guys prioritize, either industries or characteristics, then that would be also helpful for everybody. So Shereen, take it away.
Just making sure this is working. Sounds good. So I'm Shereen Shermak. About 30 years ago, I was a DMD TA at Sloan teaching the finals prep for DMD, literally 30 years ago. Since then, I've started a number of companies. I started a couple of startups in the fintech sector, and then my most recent work has been doing spin-outs from universities. I did a spin out from MIT not that long ago, Atlantic Quantum, which just sold to Google. Before that, started a cryptography company spun out of BU that was sold to another public company. And then most recently, a health tech company spun out of Duke. And I have spent the better part of the last 12 years as a very active angel. I helped found an angel group in Boston called TBD Angels, which now has over 300 angels in it. Our whole concept was based on the idea that it is very difficult for entrepreneurs to raise money, but the process doesn't have to be part of that pain. So we really focused on creating a process that, so companies wouldn't have to go through a lot of hurdles before they were even assessed for whether they would be a fit for the group. So our process is fairly unique in that we just take like a short deck or a one-pager, show it around the group, do voting. We know what the statistics need to be within the group in order for a company to actually get funded. So by that point, we can kind of predict who's going to make it. And until that point, the company hasn't even had to do a pitch. So we try to be kind, and we try to be, very upfront with no's. I think for those who are raising money, the quick no is actually the biggest blessing you can get, because you're going to face a lot of them. So our investing is usually in the first round of fundraising, so very, very early. I'm actually known maybe more around Boston for writing the first check into a lot of startups around here. And I really enjoy that and look forward to the conversation.
Great. I don't think it's on. I think there's a switch to flip out. Or maybe just hand her this one. I'll work on that in a second in the meantime.
Okay, first test failed. Hopefully we'll be better from here. Hi, everyone. Excited to be with you all on this cold winter night. And I'm Grace Mathis. I work at Hitachi Ventures. I sit on their climate and industrials team. A little bit of background on my end. I joined Hitachi Ventures about 2.5 years ago after finishing my MBA at INSEAD in France. Prior to that, I come from a finance background. I was in institutional investing, working for a family foundation on the investment side, investing across asset classes in funds. We made some early stage climate venture fund investments for the first time while I was there, and I realized that actually that's what I wanted to do. I wanted to be closer to the startups. So I went to get my MBA with the idea of pivoting into climate venture investing, and here I am 2.5 years later. Hitachi Ventures, we're obviously a corporate VC, the corporate venture arm of Hitachi, but we have a pretty interesting structure relative to other CVCs, and they're all different. But the way that Hitachi Ventures works is we operate as a single LP fund, which means that we've raised funds from Hitachi, and those funds have been committed into a traditional fund vehicle structure. As opposed to being balance sheet investors, those funds are already allocated. So we operate very much like a financial VC with a strategic lens. We're currently investing out of Fund 4 of $400 million, which we raised last year. We're $1 billion total assets under management. And we're both financially motivated and strategically motivated. So we're looking for investments that are exciting from a potential return perspective, but also that have the potential to partner with Hitachi. I don't know how much people know about Hitachi, but it's a vast organization. It's a Japanese-based company, but it's global with almost 800 business units across almost every industry that you can think of. And so as a result of that, we're a generalist fund with 4 focus areas: industry, climate, digital, and healthcare, which is basically everything. So quite broad. Like I said, I sit on the climate and industrial side. And we are seed through Series B investors. We write $2 to $8 million check sizes on average. And we have an international mandate, and we're investing in software and hardware. Corporate VCs in general tend to come in a little bit later, as was mentioned earlier. That's true for us too. We're almost never the first institutional check-in. We may do some smaller exploratory checks from like $500K to $1.5 million and then follow on after, but Series A and B tend to be our sweet spot. And we're looking to come in when a company is right at that inflection point, ready to scale. The tech is proven, the product market fit is proven. As a result, we're looking for really exceptional founders. We're looking for really clear product market fit and a big and exciting market with a transformational approach. I would say that's probably the majority of the criteria.
Can you quickly just elaborate on how you measure the product market fit, or how you can tell that it's there? Like
Yes.
some of the key metrics that you may look for?
So because we do software and hardware, including some deep tech, there's really a lot of variety. So we've made a nuclear fission investment, and a nuclear fusion investment, both pre-revenue, but we've also made quite a few digital investments. So founders sometimes ask me, what are you looking for at the Series A stage in terms of revenue milestones? And I can't quite give it because it is so broad. But what we are looking for is some kind of proof from the market that this technology fits their needs. And so that can come in the form of revenue. And if it's a software company, usually it's roughly around 1.5 million plus at the Series A in terms of ARR. But if it's deep tech, it's things like LOIs and offtake agreements. And often we'll need to do customer or potential customer calls to understand that this is very clearly a need and that there is a lot of excitement around the technology. So those expert calls are really important since we are such a broad fund. So that's
Great.
a little bit of a vague answer, but it
That's good.
varies.
That's helpful. Thank you.
Thank you. Hi, everyone. My name is Lyman Missimer, and I'm an investor on the team at Owl Ventures. Owl Ventures is the largest education technology focused venture fund in the world. We have about 2.2 billion in assets under management, and actually now just over 100 portfolio companies across 5 funds, nearing the end of our 5th fund now, and which is about $1 billion split across 2 different types of funds. And we've been around since 2013, and I think from a variety perspective, you have kind of John and Shereen, who are generalists, and I guess Grace as well. But we're a vertical investor, so we only focus on basically products where the primary outcome from using the products is either learning or training. And then additionally, we also focus on products that maybe the primary outcome for students or learners isn't necessarily learning or training, but it's delivered through schools. So for example, we have a portfolio company called Hazel Health that does teletherapy delivered via K-12 schools. So, from a sector perspective, we're focused on K-12, higher ed, and workforce, and again, anything that has to do with learning or training. And we're doing everything from kind of larger seed checks all the way up to later stage growth checks. So think between 2 million to up to 50 or more, and just that is because of our vertical focus. There's just a smaller amount of potential deals and companies for us to invest in. So our approach does have to be a bit more stage agnostic. Although we did kind of start with our sweet spot being similar to Grace's at the kind of Series A level. And I've been with Owl actually just for a little over a year and a half. And in addition to the kind of day-to-day investment work that I do, again, seed through Series D, ed tech, I also oversee M&A across the portfolio. And part of our kind of value add as vertical investors is we're super hands-on with our portfolio companies that we take on. A lot of that is partnership introductions, go-to-market support, customer introductions. We have a network of schools and colleges, and some of the endowments of those colleges are even our LPs. We make connections for our founders and entrepreneurs into the actual ed tech market to enable them to scale and grow and just provide that ongoing support that they need. That also means we tend to try and take larger ownership for the rounds that we do and the checks that we write, just because we do spend a lot of time with our portfolio companies. And that's, again, part of the reason why I kind of ventured over is I did M&A in my previous life. I was at one of Owl's portfolio companies called Newzella. I'm not sure if anyone ever actually got to use Newzella back when they were in maybe high school or middle school. But I ran M&A there, and that's kind of helped bridge me over to Owl. And like I said, we have investors on the team and partners at the firm that have specialties. Mine is M&A. We have an operating partner that focuses just on efficacy and outcomes. So enabling our portfolio companies to measure what works whenever their products are being delivered to, K-12 schools or colleges or workforces. We have an operating partner that was kind of a storied CEO across multiple ed tech companies. And again, the additional specialties and kind of operating lens that we can kind of help provide is kind of the value add that, we pitch ourselves to entrepreneurs as. And then I think lastly, I'd say, just in terms of my background, before, again, I've only been on the investment side for about a year and a half. Before Newsella, I was at Google for education. So if any of you ever used, Chromebooks or Google Classroom in your, kind of K-12 school years, I worked on the early days of those while I was at Google. So again, I've been mainly on the operating side my whole career, but in the ed tech space. And yeah, I think, John, unless I miss anything, I think that's me.
Awesome. All right, super good. So we heard a lot of different characteristics and types of financing. Joe provided some additional elements like grants and revenue and prizes and other stuff. And then you have your sort of professional investor set as well. And then within that, we have different types of investors. You have Shereen, who can invest as an individual person, just as a human, as an angel that likes your idea. Also can organize an angel group to come together with multiple people who operate slightly differently, make decisions as a group together. And then you have institutional investors that are typically investing other people's money. So we raise money from high net worth individuals, $25, $30 million, and then we go out and look for opportunities and we share profits with them on a specified time schedule. And then you have corporate venture groups, which sometimes invest off their balance sheet, and sometimes they have a separate dedicated fund. And then you have different stages, and you have different industries and different geographies and different criterias that each of these groups or individuals prefers in their investments. So it's kind of daunting a bit. One of the key takeaways that I would suggest from all of that is it is very important to do your research before you approach these investors. I get multiple cold emails every single day pitching me on hardware startups in India, for instance, but lots from all over, right? And the fact is, like, the very first line of our website says software startups in the US and Israel, right? Like, this is just out of scope. Or they're at Series D and they're raising a $100 million round. And it's just like enormous waste of my time, enormous waste in the system, and there's no way that they're getting funding from me. They're just out of scope, period. And so you can frustrate investors by approaching them incorrectly. Now, you won't know everything about everybody, fine, but at least on the basic characteristics, identifying what's the industry that they focus on, what geography, what's the general stage that they focus on, and then approaching it, and this I'll segue into this with you guys and how you like to be approached and where you tend to find your best startups and how you sort of prefer that they engage with you. But this is another element, and I will start by saying that a cold outreach is very rarely effective. Like I will sometimes review them, and I have taken calls in meetings, so it's not impossible. But the yield rate is incredibly low, like 1 out of multiple hundreds. Whereas getting a warm introduction is the way to go, right? If I get an introduction from somebody who's an investor in my fund, I almost have to take that meeting, right? If I get an introduction from one of the investors up here that I know and respect, I'm going to take that meeting probably, right? So it's just much more likely, because there's so much noise in the system, we have to come up with ways to filter it relatively quickly. The first is it in scope for me, the right stage, industry, focus, et cetera? And then does it come with some credibility right out of the gate? And that is typically a warm introduction. So that's what I would strongly recommend, is find somebody that we know in common. Incredibly easy to do. We know, I bet, 75 people in common with every single person in here. So you can find somebody that's relevant and get an intro through them, somebody that you know well. You can go and then I also would say that it is most helpful generally to approach those first meetings. Even though it's known that you're probably raising money, it's ideal in many ways to approach for advice first, to share ideas, to ask questions. Is this the type of startup you invest in? Is this the type of stage? And then it's a much more low-key, low-pressure kind of conversation, and everybody can be open and build a relationship before you get right into the let's get married question, right? It's a little bit of let's date for a little bit first and figure out if there's a good fit here, is kind of how I think we generally approach it. So let me pass that sort of similar line of questioning along to you guys. How do you like to be approached? What methods are effective? Any sort of red flags that you would say don't do this is negative, et cetera? Anything along those lines?
Well, I'm kind of in violent agreement around the cold outreach, although especially for students, it's very, very hard to have that kind of network that you need. And so the professor, before we started this, talked about other sources of funding. And one thing, I've been doing a lot of fundraising lately with either startups that I've invested in as an angel or startups that I'm an advisor to or part of. And the thing that's working best nowadays is really to go out to incubators first. These are formal programs. They've set aside slots. A lot of times there's 100K or 200K that comes along with it, which is fantastic. And once you're in that fold, then the entire proposition of most incubators is to make introductions for you. So it's instant network. And so even if it's a little inconvenient where the incubator is, or you're not really sure how you're going to use it, if you have, as a goal to build your network, getting into an incubator is probably an amazing first step. In terms of our angel group, somebody in the group actually has to sponsor, sort of take the deal through the process. So what that means is either, somebody else in the group got a pitch they really liked and they posted in our Slack channel and tried to find somebody who wanted to attach themselves to it, or somebody got approached who's an angel in the group who really liked an idea and wants to take it through. So we actually need warm intros as well, even as early as it is. But the good news is that there are about 350 of us now. Everybody in our angel group, not everybody, but about 80% of our angel group are operators who have either made their money on exits or are executives at startups that were acquired or executives at large tech companies. So everybody's pretty empathetic. So it's a little bit easier to approach, but it's still the same volume ratio question. Angels are not professional investors. They're doing it with their own money. So they don't necessarily, sometimes have other jobs or they're advisors to lots of companies. So they don't really have time to filter through. I get probably not as high quality stuff as John gets in the inbox, but I do get a ton of just cold stuff, and I really don't have that much time to parse through it. The best way to reach me is always through LinkedIn. I think that's the best way to reach almost anyone. And usually if you just search on the person and you see who they're connected to that you're connected to, that's probably the best way to start.
So a couple of things to add on, and I'll just share that I am coming at it from a Series A plus perspective mostly. So keep that in mind based on this advice. But I think first for students, it's much easier to build your network or you have an advantage in building your network in that you have the MIT logo on your LinkedIn, for example, and people are just really willing to share their time with students. So I think there's an opportunity to build your network less from a pitching perspective, but more in terms of broadening your reach to who you know. And I think that can be really helpful, is reaching out as a student. Hi, I'm really interested in what you do. I'd love to learn more, as opposed to I have a startup that I want to pitch. And that will help you to just expand your network to begin with, so that the chances that you have more mutual connections is higher and higher. Second, I would also ask the question, do I need to raise venture capital funding? I know that grants have obviously taken a hit recently, but there's still some really great options out there from both a state and federal perspective. There's some really great resources around Mass CEC and others that are Massachusetts specific. I saw the Family, Friends, and Fools on the website of this class, giving an example of bootstrapping or raising from your maybe inner circle. But there are a lot of really successful companies out there that don't raise venture capital funding. And so I think it's really important to understand why and if you need to do that. And then from the Series A perspective, what I'll share is investors get a lot of FOMO. And so if you can get your name out there without cold outreach, that's really productive. And some ways to do that is through thought leadership, sharing on LinkedIn. If I'm looking at a new topic, I will often do a LinkedIn search to see what articles are out there. Conferences are also really great to get your name out there. And the second that you land on some other investor's market map, you all of a sudden have a whole broader reach than you did before, because investors want to know what other investors are looking at, and there's a lot of trust that exists across investors. So if you can do that without cold outreach by getting your name out there and your company's name out there, that's really productive.
Awesome. Yeah, and just to build off of just the amazing insights from Shereen and Grace, I think getting into the funding piece, in different verticals, there are probably additional options in terms of non-dilutive funding that you could pursue. In education, for example, there are just a ton of foundations. There's Lorene Powell Jobs, Emerson Collective, Bill Gates has the Gates Foundation, CZI, Chan Zuckerberg. There's a lot of research focus and philanthropic organizations that also provide a ton of non-dilutive capital for earlier stage ideas. And these are very vertical specific to education technology. And you need to research the lens in which they're actually giving out their philanthropic dollars, which does change year to year. So I'm not sure about other verticals, but if you do know what vertical you want to build into and what problem you want to solve, there could be additional options that are vertical specific that you might be able to dig up. So we definitely encourage you to pursue that path, especially in industries like education where efficacy is becoming even more important. And to prove that for a product that you're building, you need probably a couple more years than most venture capitalists have the patience for, especially at the earlier stage. So just wanted to call that out. But in terms of getting in touch, I actually, on the flip side, I love a good cold outreach. My first job was sales, so I think I just have appreciation for that art. But if you're gonna do it, I think John mentioned this, and so Shereen, you need to do your research before. The ones that I've responded to and replied to, and maybe this is also a bit of ego, but they knew I loved soccer. They knew my favorite soccer team. They had done research on my career. They listened to a podcast I did in 2012. So if you're really sure about the investor and you align with their thesis and the stage at which they invest, make sure your approach is super targeted, because that can work. At least it works on me. On the flip side, though, if you are going to go the warm introduction route, make it really easy for John, Shereen, or Grace to do that intro for you. And so do the same amount of research, tailor your email to the person you want that intro to, and make sure it's super relevant and just copy paste for anyone you're asking for that favor for. So the kind of, whether it is an intro or a cold outreach, just that initial research on the person you want to talk to is super important. Like, what investments have they done? Again, where did they go to school? Why, and maybe make kind of a connection there. Whatever you can do to, again, personalize things, I would encourage that. And yeah, I think that's all I have.
Awesome. So a lot of really strong insights in there, and I think one I'll start off with right off the bat that Grace mentioned is that VC is not for everybody. Like, VC money is not. It's easy to think, because VC is a strong industry with its own strong interests. It gets talked about a lot, and because a lot of the largest companies raise these huge, eye-watering numbers, it feels like that's the way to go. Similarly, a lot of you on campus will get approached by consulting firms and investment banking firms and feel like those are the only jobs in the world, apparently, right? But it's just because they're loud and arrive early. But it isn't for everybody, and the same thing with venture capital. So there's a lot of other ways to fund your business. Some businesses will just never be well suited for venture, and you can try as hard as you want and you'll never get it, because venture really relies on a power law curve of returns. And so essentially every investment that we make or look at, we're trying to determine, is there the possibility that this company at exit will return the entire fund that we have? So if we have a $25 million fund and we're going to buy maybe 5% ownership up front, and then we're going to get diluted in subsequent rounds because we don't have infinite money, so we can't keep investing forever. We'll get diluted 25%-ish in each subsequent round down to the point where there's an exit. We might only own 1.5%, 2%, even less potentially depending on how much they've raised and the industry and whatever. And so then we think, all right, if we need to return 25% profit, $25 million profit for us on 1 or 2%, you can do the math on what that exit is. And then you look at the company and say that that company has to, if you want to have $1 billion exit, you probably got to have $100 million of revenue, roughly. So can you get to $100 million of revenue? And we need it done in less than 10 years, because that's the fund cycle, ideally 7 years. So you're really looking at, can you get to $100 million of revenue in 7 years? And the fact is that almost, like, very few companies can, right? And so they're just not going to be very well suited for venture capital. Instead, though, grants, revenue, and there are certain investors, not all angels need the same types of returns because they're not investing other people's money. There's not as many fees and other things in the way. So I think that's a very key point that I didn't make heavily enough up front. And it is expensive money. When VCs get involved, we are beholden to our investors, right? So there's a chain of anger if you're not performing, right? And that means that you get on a treadmill that can be very fast moving. That is, look, if you're going to get to 100 million in 7 years, you need to be at 50 million in 6 years. You need to be at 25 million in 5 years. You need to be at 10 million. You got to get on like a very rapid cycle. And so if you're not hitting your metrics, I've got 36 investments in my fund. I'm going to start focusing on the other ones. And it's going to be hard for me to answer your phone call and help you because I got too many mouths to feed and you don't look like you're the winner. So it typically is only 3 to 5 maybe startups within a fund that pay for all of the returns. You'll get one of them that might return 2x the fund, or 1x the fund. The next 2 will return the fund again together, and then all of the remaining ones after that will return the fund one more time. And so you end up just seeking out who are my top performers and focusing as much of your effort on them as you can. And that, again, means that not all of you will be well suited for it and get the love and care that you deserve. So that's a key point. Do you want to add something on
I
this?
was just going to add, it's true, venture capital can be a very brutal process. And it's not always particularly well suited to deep tech companies or hard science companies and a lot of the kinds of companies that do spin out of MIT. So there are certain types of funds that are really set up to handle deep tech companies, like MIT participates in the engine, and there are other funds around that really focus on deep tech companies, and they tend to take bigger risks over longer terms. So their point of view is a little bit different than what John's looking for. In some ways, it's even more brutal because they're looking for the 1000x return that that only a very novel deep technology can deliver. So one of the things, because not everybody is born wealthy and can't just pursue a company without any money, one of the things about being a student is that it's a natural advantage if you want to get going while you're in school or spend your summer on a startup. MIT, Harvard, and many of the schools in the Boston area really do allow you to, they have grant money for the summers and that sort of thing. And it's a great way to take that kind of risk in an environment where if you fail, like nobody's going to know. And so it's just experience for you and track record for nobody. And if you're in a position where where you can't go without an income or, understand how your rent is going to get paid, good time to get started before you leave school and start getting some proof points if you already have an idea. So I'd say earlier is better, and acknowledge that you may, if the idea isn't something that's VC fundable, you may consider doing something else half-time to just support yourself, and use that to keep you sustained. But I've seen all kinds of creative stuff over the last 6 or 8 years. Helping companies come out of universities, and most of those entrepreneurs really had no money. So it was a lot of creativity about how to keep things going, how to find the next 100K from an incubator to make sure everybody was okay.
Absolutely. We would completely concur. Now is a great time to be experimenting and building your network as well, to our prior points. So like when I launched Mass Challenge 2 years out of business school, probably 80% of the people I talked to, the network from which I built that, were people that I met at MIT. So Joe was one of my advisors and mentors while I was at school. I came and pitched the idea to him when it was still literally an idea and we barely had anything on paper and it was not worked out. He gave me excellent advice, introduced me to 4 other people, right? And I talked to a variety of other people, my professors from school. I talked to Desh Deshpande, who had spoken at a conference that I ran. So I had built a network up of people while I was at school when it was low cost for them and low cost for me. Just let me learn from you, let's learn together, let me share ideas with you. And then some of them became my investors later in life or became my donors for Mass Challenge, which is not a nonprofit. And so build those relationships before you're asking for money is one of the pieces of advice I would give. And in general, learn and experiment with your startup and all of your ideas while the cost of failure is low, which is while you're at school. So this is definitely that's a very, very strong piece of advice. And then I think another piece that came up earlier that we're talking about is how do you distinguish yourself when you are approaching somebody for money or as an advisor, or even if you want them to join your team? You're sort of always selling this idea. And when you're a really early startup, you have no brand, you have no money, you have no power in the market, you have you have nothing to offer. So you're often trying to steal an engineer away from a $400,000 job at Google to come work in your basement for $0 on a company that nobody has ever heard of that is doing something that you can't really properly describe, right? So it's really hard, and you have to get good at that kind of sales approach, and you will learn through urgency and desperation, if for no other way, that you have to figure out how to distinguish yourself. And that can be through pedigree. You can leverage, this is MIT research that is leading to something that gets people's attention. Like if you're an MIT graduate, it is name dropping, I get it, but it is effective. That is something that should be clear in your pitch pretty early on. If you went to the same undergraduate school as somebody that you're talking to, or if you like the same soccer team, or anything that you can find that personalizes that outreach and finds a common affinity or bond with that person is a positive. And I agree, I do answer cold outreach, but primarily when it's well targeted, right? And it's like, oh, I saw this talk that you gave and I really appreciated this point. We're doing something similar. I also know this person that you know in common, whatever. Then there's something that's like where they've done some research instead of pitching me on a fishing startup in Guatemala that I'm like, this is so out of my scope. So personalizing it, leveraging, figuring out how to define your differentiation. Excellent. All right, so what about, I sort of started on this a little bit, I guess, but how would you recommend that people start this process, both sort of getting their startup launched, finding advisors, finding funding? Like, let's say that somebody here today has an idea, they're alone, that's all they've got, just a brand, an idea, but there's nothing really built around it. How do they get started? What do you recommend for some of those steps, and how does that lead towards funding? We can start maybe on the other down there with Lyman.
Yeah, I'll start. I think write stuff down is, I think, the biggest piece. I think just an anecdote. There was an undergrad at Stanford who cold emailed me in a very targeted fashion, and had written this kind of thesis on the ed tech market through a bunch of research that he did by talking to school administrators and teachers. And honestly, in my previous world, we had paid, consultants hundreds of thousands of dollars for a similar level of insight, and he had just done this research himself. And so it was my way of getting to know his point of view and perspective on the market and why he was a unique choice to be a founder in the space. And so, especially if it's an early stage idea, I think, the more you can write down, the more you're willing to share on, what you want to build, what problem you want to solve, and why, and the unique insights that you have that someone else might not. The easier it is for us as investors to kind of ingest that data and, pattern match whether or not, you have, again, something unique that is fundable, especially when it's the early stage. And so I think the more you can write down, and especially the more you can share with investors once you get their attention on that front, the better. So, a deck is great, but 10 pages on what you're doing and why, for me, I think is helpful for you to get everything down and just I think better synthesize what you're trying to do and what you're trying to build. But more importantly, especially in the earlier stage, I think it can really help differentiate you as opposed to someone who just has, maybe put together a 10-page deck with just not a ton of data information. So just, that's a bit anecdotal, but for me, especially for earlier stage ideas, I found it's really helped entrepreneurs stand out, at least from Al's perspective.
I would say, in addition to writing it down, talk about it. If you are a aspiring founder with an idea, you're looking for teammates. We rarely invest in, we invest at the Series A, but we're often investing in companies that have co-founders. We almost never invest in a company that has only one co-founder. And the reason is because teams are really important for, I think, accountability. I think a lot of people will say being a founder is quite lonely. There have definitely been successful solo founders for sure. But in general, we as investors at Hitachi Ventures tend to lean towards co-founders. And I think the way to find co-founders and strong advisors is to talk about it with people that you trust, with people in the industry, get feedback, adjust. I think one thing that's really great about university programs or grad schools is you can often find yourself in a room with people who are focused on very similar topics, especially if you join clubs and things like that. So building your network around a specific topic is also quite important. And people are excited to talk about these topics. Like if you're building something in the space, you're likely very passionate about it. If you're talking to other people in the space, they're likely also very passionate about it. And what you really want is a situation in which you share your idea and somebody is like, that is a great idea. How can I get involved? And you probably have to have a lot of conversations before that happens. But I think continuing to have those conversations, continuing to refine how you tell your story is really important.
Yeah, I mean, I guess I'm in pretty violent agreement with that. My next startup is actually going to be with a fellow MBA from Sloan, who I've known since we were friends at Sloan, which was, as I mentioned earlier, about 30 years ago. So the network never really stops. The way she figured out, to reach out to me for her startup was she saw an announcement of an exit of a startup I had just done. And so she's like, oh, maybe you're coming free. I could really use a COO, or if you know anybody. A lot of those discussions are super awkward. I know John's like a pretty big extrovert, and maybe these guys are too. I am, especially if you were in sales, I'm a complete introvert, and I'm never going to be the one like running up to people, but I will share my thoughts on LinkedIn on a subject, and it's surprising to me how much engagement you get if you say something that's unique, that's not just repeating what everybody else is saying. And then your network sees it, and your network just kind of accrues over time. Most people who are at Sloan or in grad school have a couple of years at some other company beforehand, so you're starting to widen the group of people who are going to see it and who are potential co-founders for you. But I wanted to highlight the fact that Patty and I are starting this company because it is one of those, like, it's never too late to start a company with a person from MIT.
Awesome. Also, such great advice there. So writing, and I'll give you guys some specific ideas on how to write this stuff down that I have found really helpful. So I do think that's a great piece of advice because a lot of times it makes sense in your head, but you don't realize how vague it is until you start to write it down and you realize, like, I don't actually know who my customer is, who's paying for this thing. And so writing gives you some structure and forces you to some discipline on the idea. And sometimes that will help you determine that the idea is not viable and you don't want to do it after all, or sometimes that it's genius and actually you've got an even better way to approach it. So one thing that I learned that worked really well for me is something that I learned at Bain & Company, actually as a consulting practice, but applies well for startups. And they call it answer first work planning, and it's basically the scientific method, which is write everything down as a hypothesis, and then that you can go and test and verify, and then go test them in sequence. And when something comes back failed, it doesn't mean the whole idea is broken. It just means that subsection, that hypothesis, may need revision. So, for instance, with Mass Challenge, I did this, and we started, like, literally just started with writing down as a series of statements why it was going to succeed. Right? We will create the largest ever startup accelerator because. And then it was, we can secure the funding we need from the federal government. That was the original idea, which was proven false, right? But so that was like the first idea. And then it was, Boston is full of talent at all of the great universities, and we will be able to access some of the best ideas in the world right in our backyard. That proved to be true, right? And then we went down, we will be able to secure judges and mentors as volunteers for free to work for the nonprofit as long as we engage the community and make it worth their while. Check mark, that proved true. And so went through all of these, and as we started pitching them, originally we had the idea for a fund, and we were actually going to invest in the startups. We would raise $50 million. And then I want to highlight this because like your idea will not only be wrong, it will be embarrassingly wrong. Like you will be ridiculed. You need resilience in this process. Even whether you're it's much easier as an extrovert. I'm used to this, so I acknowledge it's much harder as an introvert. But either way, you're going to have to prepare yourself for a bit of humiliation and just resolve yourself to go and do this. Or right? You got to fight your way through it. And by the way, I want to open up for questions after this. So start thinking of your questions. But so as an example, we gave a pitch that we were going to have a $50 million fund, and we were going to solicit ideas from around the world. Anybody can enter with any startup in any industry. And then they would go through a judging process. They would get 3.5 months of free office space and accelerator support. And then at the end, there would be a final judging program. And then we would give out Series A investment would be the prize money. And so like the very first meeting we had, because we had no brand yet, we were very new. And so we had like a junior lawyer at a firm, it was not even the person that we needed to be pitching, but we were just pitching the idea, enthusiastic and wild-eyed and swinging our hands around. And she was like, okay, so you guys have, you're gonna have a $50 million fund. How many funds have you guys run before? And we were like, none. We have not run any funds. Oh, okay, so you're angel investors then? Nope, actually, zero, no angel investing. Oh, so you're just like, you're like the children of billionaires or something? How are you? This was in 2008, 2009. So it was like the worst economic period in living memory, right? Banks are collapsing, and she's like, money is fleeing risk as fast as possible. You think you're gonna get 50, how long do you think it'll take you to raise the $50 million? And we were like, probably like 3 months or so. And she was like, yeah, I admire your balls, but you can get out of my office now because this isn't gonna happen, right? And it was just like, we were just wrong. It was just like a bad idea. Now, just that element, the rest of the idea was, I think, still genius, and it worked almost exactly as we modeled it out. So some elements are going to be not only wrong, but embarrassingly wrong, like kindergarten level, because you're not gonna be good at everything. The first airplane built was not a 747. You have too many pieces to figure out. You got to figure out lift and materials and a whole supply chain and so many other things. So you're going to have this big vision, and a lot of it's going to be wrong. And a lot of entrepreneurs get tripped up when they are told no, or they're told that's stupid. But the fact is, it probably is stupid, and that's okay. The first idea is the first idea. You just have to iterate. And so resilience is one of the most important characteristics. You have to, and what that comes down to, and for me at least, everybody's a little bit different, but for me that means I can't launch something, I shouldn't launch something, unless it is something I can't not do, right? I need to be obsessed with it, and I will write out a bunch of ideas. I wrote out like 10, 15 executive summaries of ideas that I wanted to launch, but they didn't capture me. Like I wrote it out and I was like, I don't know. I'm not quite there. But when I had the idea for Mass Challenge, I was like, we could catalyze a renaissance. Like we could change the entire planet at a time when everybody's holding a cell phone, information changes hands instantly. Like this could be the next Italian Renaissance, but a global Italian Renaissance on the back of genius, creative entrepreneurs. And I'm not an engineer, so I can't build those ideas, but I could rally them. I could rally the community and the resources that they need, and then I can be part of it, and that would be so amazing. And then I couldn't sleep without planning it and thinking about it because I couldn't get it out of my head because it's too good of an idea. That is the idea that, for me, I can't do it unless that has that level of passion and support. And we look for that kind of passion in the entrepreneur because it is going to be super hard. You're going to fire friends. You're going to lose money. It is a roller coaster. It is really difficult, like way more difficult. I remember Joe actually said to me, I want to tell you how hard this is going to be, but I really want you to do it. So I'm not going to. So go ahead. It's going to be great. You're going to do it. It's going to work. And it's the right attitude. Like if I had known how hard it was, I might not have done it, but it was the best thing I've ever done. And I think that you have to go into it with that. So that resilience is important. So write it down. So that, for me, it was the answer first work planning was very important. There's like the business model canvas from Lean Startup. Mass Challenge has questionnaires. Y Combinator has questionnaires. Look, just like you can search the web, there's a billion. So just find other templates and structures. Try whichever one suits you well and fill out those forms. That's good. And then pitching is the other thing. When I got excited about Mass Challenge early on, I would literally pitch people in the grocery store. When I was in line, I'd be like, hey, how are you? Hey, can I just bug you for a second? I've got this idea. What do you think? And that's because and again, I'm an extrovert and it comes easy to me. So I can do that. It's not for everybody, fine. But like go find your Joe. Go find somebody that's an advisor that you trust, a professor, a good friend, your family, anybody that will listen to you. They don't have to be a genius at first. You just got to learn how to externalize your ideas and make sense out of them and get some feedback. And for the most part, they'll tell you, okay, it kind of makes sense, but that one part is stupid. And then start working on the things that everybody's telling you don't make sense. And you improve it to the point where your friends aren't giving you slack anymore. You go up a rung and say, let me try professors or researchers or successful entrepreneurs. And then you start climbing up higher and higher until you're talking to sort of billionaire investors and they're telling you that it's a great idea. And it took us a long time of pitching it until people stopped telling us we were dumb and started saying, that's unbelievable. How do I get involved? Can I be an advisor or something? Can I give you money? How do you? And I was like, I think we're onto it now. And then you sort of figured it out. And so write it down, pitch it to as many people as you can. And then I would say another note that I forgot earlier on the VC is expensive. Right now, like AI is such a great operating partner. You can lower your costs so much that you don't need to raise maybe venture money at all, or at least a lot of venture money. It's not for every business. Like fission won't be solved this way probably, but a lot of software companies, a lot of other things you can use it as an operating partner. And the studies have shown that you can get 3 times the revenue per employee by leveraging AI with lower costs than like 35, 40% lower costs. So that means you can raise significantly less money, dilute yourself less, keep more of the company in ownership and control of it, maybe do a seed round and then skip a bunch and then jump to growth stage or expansion stage, or just go to a B or something else. And then it's just like a lot better for you and everybody. Money is expensive, so try to keep your costs reasonable and wait until you're confident that it's working and you need the money to scale or grow or to hire the right person or for a specific purpose, because it is a pretty fast roller coaster and not everybody wants to get on. So make sure you're ready at that time. All right, anybody else, any other quick thoughts? And then we'll open up for questions in a minute. And we have t-shirts we'll give out to people that ask questions in the room, so.
I had one comment I felt like was important. As you're doing this process, you're writing down, you're starting to tell your friends, you have to get out and talk to your market, talk to your customers. The only way when you're like by yourself or you're with a buddy in the basement working on something, one of the most convincing things you can tell a VC is we've talked to 20, consumer products marketing people, or, we've talked to 20 ad tech sales guys. We've talked to whoever the market is, and this was the feedback we got. Put in direct quotes. Make math out of these subjective conversations. I've had 20 of them. Half of them were, about this. So like those data points, you can also start collecting really early about whether this is an idea that the market is going to accept. And that can be some of the strongest stuff you can put on paper. It's not necessarily sitting at home like building a financial model or writing a deck. You really have to kind of get out there, and even introverts or not, you're not allowed to not sell. And so you have to start selling from kind of day zero. Reach out to your network. Don't hard sell anybody. Just say, hey, Uncle Steve, I've got this idea for a wine company and you're a sommelier. Can you tell me if this is dumb? And would you buy it? Or how much do you pay for something like this? So something to do early.
Absolutely.
And I think just to add to that as well, Shereen, you were kind of hinting this right at the end there, but this is really simple, but write down the like 10 questions you're going to ask in all 20 of those conversations, and make sure you knock them out, or at least be consistent, and just have a plan going into every one of these conversations, and at least a base set of questions you want to ask your potential customers, instead of just kind of going in and navigating the conversation free flow, which is a more kind of consultant-like approach. But yeah.
Just one thing to quickly add, to take even a step further, I think start with a problem and develop the solution as opposed to the other way around. I think sometimes we see absolutely brilliant tech, but it's not solving a very clear pain point. So start with the problem.
Totally agree with that. I had before the executive summaries that I threw away that I didn't do before, that were my ideas before Mass Challenge. I was starting with the idea that I want to be a successful tech founder. I want to be Bill Gates. So how do I get there? And then you can't get there from here. There's no path to that thing. But if you start with there's this thing that's wrong in the world, it's too difficult to launch a startup, which was the problem that I realized I had. Common engineering mistake, because engineers build beautiful code that they love that nobody wants to buy. And that is not a good business, and you will waste a lot of your life and energy trying to sell something that people don't want. So excellent, very, very good point. All right, let's open it up for questions. Sure, we got one right here. And I'll repeat it so you don't have to wander around. Or go ahead, if you're gonna be quick, you got it? Yeah.
By the way, I think it's very important for founders that we also find the right investors.
Yes.
What questions should we ask you?
Very good questions. Glad you brought that up. I forgot to mention that. Anybody want to jump in? I have thoughts, but.
Every time I approach an angel, and as an angel, I really respect when I get this question. How many checks have you written in the last 12 months? It's very particular to the angel space where, people may just, never really write checks or write very few checks or write very small checks. So just asking them, what they've invested in recently and how recent is recent, you'll know whether you're wasting your time. And if somebody hasn't committed by the third meeting, they're probably not gonna.
I also, back to John's point before, the FOMO route certainly works on me. Hey, what other ed tech investors, in the space should I be talking to or having this conversation with? It's a great one to end the conversation with, and a lot of times I will answer. Maybe I won't necessarily give the intro, depending on if it's a competitive firm or not. But I think going back to some of the points I made before, the more your questions kind of come off like you're asking for advice, I think the better. And so I think that's just a good general framework for a lot of the questions you are posing to investors, is really just in terms of advice. How much do you think I should raise? What does this traction feel like to you? Am I at the point when you would consider giving me money? Again, what other investors in the space do you like? But yeah, I think the more you can kind of create FOMO with us, with your questions, the better.
Maybe to provide an alternative perspective, because all investors are different and you should take everything we all say with a grain of salt. I actually don't like when people ask me how much should I be raising. And that could be also a Series A, Series B thing versus earlier stage potentially. But sometimes that signals to me that you don't have a very clear plan for why you need to be raising or what the use of funds should be. To the FOMO point, I also think, I will ask, what is your fundraising timeline? And it's very helpful to have an answer as opposed to kind of a loose fundraising timeline or I don't know how much I should exactly be raising. We're still you want to have a pretty clear story, yes, and create urgency. Again, that could range at the Series A and B stage, but that's pretty important. I think the question of, once it's a pass, or if on a call, sometimes I'll be like, this is a touch too early for us, likely. I think a really good question is, what would you need to see in the future for it to no longer be too early?
Yeah, great. So I think I forgot to repeat the question, but the question was, what should we ask investors? Because you also are startups are also selecting the investor, and so what should they be asking? And I agree with everything that was said here, and I think it will vary, and everybody has slightly different preference. I think it is very reasonable to ask, are you investing actively? Because there are funds. We have cycles, and there are certain parts in the cycle when you don't have money left to be investing, but you don't want to turn away meetings because maybe it's the next Facebook and you want to find out about it, and maybe you could get some money together. So there are people that are just sort of tourists and pretending to be investors that aren't actively either as angels or funds. And so I think it's very reasonable to ask, are you actively investing? What's your typical check size? What's your process? How many meetings does it typically involve? What are your key criteria? What metrics do you like to see for a company of our type? Who else have you invested in that is similar to us? And I think it's important to ask how we engage. Like for us, this is, I think, a real strength because we're very founder friendly, but every firm will say that. So you kind of got to dig a layer deeper and figure out what does that mean. And some funds will get on the board and really want to tell you how to run the company like that. And that's a value add. That can be very helpful if they're super knowledgeable operators, but it might not be what you want. And we typically will say, look, the founder is the founder. You own the company. And so we will not force you to take any advice, and we will give you our opinion, but you get to make the decision at the end of the day. And what we're really good at is we can do strategic advice like anybody else, but I don't think we're that much smarter than the rest of the world. What we're really good at is we have an excellent network and we can make introductions. So if you tell us the types of customer you're seeking, I can tell you 10 people that I could introduce you to. And it's reasonable to ask, like, which types of companies do you know in my space? Is your network good? That's a very smart question. It makes me think, this is a good salesperson. This is somebody I want to work with. They're going to build revenue quickly.
One more point, because I forgot I was supposed to be giving the corporate VC perspective as well. Asking about how you engage with the corporate if you're talking to a corporate VC is also a really good question. And also understanding their fund structure, balance sheet versus separate fund sometimes alludes to ability to follow on in the future. So
yeah, this is a really key point that not everybody will understand. So if you're a CVC that's investing off the balance sheet, the problem is that means they have money allocated this year, but next year they might not, right? They're just getting money allocated on a budget cycle, whereas a separate fund, it's dedicated. There's 10 years of funding or some number of years depending on the company. And so that means the money is there and it's available and they will continue to make investments. It's not at the whim of the C-suite that might say, you know what, let's do marketing this year instead. So it's a distinction in any case. We got another question way back.
Yeah, I'd be curious to hear a bit more about doing due diligence around founder friendliness. I think there's a concern as it relates to maybe deep tech or hardware space where things take a little bit longer. Someone coming in and getting involved and trying to bring something to market that, ideally you get it there as fast as you can, but there's also severe limitations.
Yeah. So the question is around how founders can do diligence on how founder friendly the funds are, and with a particular focus on the sort of hardware space where it takes a little bit longer and maybe you're not going to jump to revenue right away, and does that introduce pressure and challenges?
Two really quick thoughts. One, do reference calls on your investors, ideally to their portfolio companies. And two, check what else is in their portfolio. If you're a deep tech company and they've only invested in software, they better have a really good reason why they're going to be the right investor for you.
I'd say the same. You definitely need to talk to other companies in their portfolio. If you do a reference call, it's probably somebody that loves them. Maybe look around the portfolio and see if you can find somebody else they've invested in who maybe isn't one of the 2 or 3 top in their portfolio, and see how they're treated. Are the board meetings vicious? Are they forcing a recap? Like, there are a lot of really ugly things that can happen over time, and the other companies in the portfolio are probably going to be the ones that have the most exposure to it.
Yeah, I agree. I think that all makes sense. And then I think we have a question right here just behind you, man. Go ahead.
First off, thank you all for your time tonight. This conversation has really been great. My name is Devon. I'm at Sloan in the EMBA class. So John, we had a pleasure meeting during Idea Week, so thanks again for coming today. I'm in the education sector, so this question is for Lyman. Often there's the asymmetry in education where our end user is not necessarily the buyer. You mentioned introductions on how you support your entrepreneurs. Could you talk a little bit about how you help them to identify and narrow down the buyer path?
Definitely. And great question, and very cool to hear you're in the ed tech sector. We should chat after. So you're right. When you're selling to schools, at least higher ed and K-12, most products are built for teachers and students, or professors and students, but bought by superintendents, chief academic officers, or just other administrators, again, that aren't using the products. And so that is probably one of the more frustrating dynamics around building into ed tech in general. And so for us, each investor on the team and our firm in general, we have a network of superintendents, chief academic officers, chief CFOs. Also on the higher ed side, a lot of endowments are actually LPs in our fund, so we can get access to potential buyers at those schools. we use those networks firstly for diligence. And so whenever we see something new and we start getting really excited about it, a lot of these folks that we collaborate with on the buyer side will help us give the kind of first look and initial feedback and help us understand, is this actually a problem in the market? Is this solution going to be exciting? And then a lot of times, if they get excited about those products, we will connect them with the portfolio companies after, whether it's for customer conversations. A lot of times they've become advisors, where they'll take a little bit of equity in the startup that we've also invested in. So that kind of flywheel in terms of just, deep buyer connections that help us with our diligence, and then potentially advise the portfolio companies after. That's I think for us, the network that we've created and the value that we provide our portfolio companies. In terms of making that connection, tactically speaking, we have portfolio companies that have successfully done basically each route in EdTech. So you can go bottoms up, which means building a product that just a bunch of teachers adopt. You probably have a free version of the product, or at least put most of the product out there for free, so you can acquire millions of teacher users, millions of students, and then start to monetize schools kind of from the bottom up, and then eventually districts and buyers. On the flip side, you could build a product that maybe is better for a tops-down sales motion where you're selling to superintendents because maybe you're selling some type of like whole district change or software that's used across just the administration. So, we have dozens of portfolio companies that have had successful routes in both kind of ends. And so we would bring the kind of operational expertise in terms of, how do you chart each path bottoms up or tops down and make those connections between buyers and users, just from a tactical perspective as well.
Great. And then, Joe, how are we doing on time? We're okay? One more, two more? Maybe a couple more questions. I think we have a mic right here in the center.
Thank you so much for the talk. There was a mention about teams being more successful or gaining more traction. But there's also a common failure where there is a conflict between co-founders. Are there any signals that you're looking for when judging them, and any advice to them on this topic?
Yeah, so the question is, often a lot of funds or investors are reluctant to invest in solo founders and prefer teams of co-founders, which I think is generally the rule. But then also you have problems where sometimes co-founders conflict with each other. So how do you resolve those conflicts, and what sort of general advice around solo versus co-founder led?
That's a tough one. It's very hard to spot out of the gate what's going to happen down the line when things get really stressful. If you have the option to work with somebody you've known a longer time, that's the only way I can see where you could control for what's going to happen later. You need to see people in times of stress. And one of the things that you can do is set up a period early where you're just kind of working together for the first 3 or 6 months. Maybe you don't really have a formal agreement. Maybe you're still in school when you do it, and see what happens when you start to put together pitch decks and have discussions that don't go very well. But there's only so much you can foresee. There are a lot of reasons why down the line, a member of the team leaves. They're, a really good person in the beginning as a generalist, but maybe they're not deep into your tech. Or you have a personal conflict where you really found out that you don't really just like each other and don't want to spend a ton of time together. And all of that is okay. You have to start somewhere, and you have to try to create a way of decision making between you. So what we've done is usually divide responsibility and accountability, together, pair it together. So if I'm the CFO and somebody's going to, be mad if I don't have X, Y, or Z calculated, then I am the one responsible for it. And while your opinion is important, it is not a decision. The other thing when I've been a non-CEO is to agree with the CEO that if we disagree on something, you really have to listen to my best 10 minutes on why I think you're going in the wrong direction or why I want to do something before you reject it. Open mind, 10 minutes. If you still say no, I'm not going to ask you again.
I'll add here that it's a great question, and I would say there are multiple ways to launch a successful company. It can be done by solo founders. We invest in solo. It's a flag when somebody comes to us as a solo founder. We will discuss it, but we have invested in multiple solo founders. We've also invested in teams where the team has collapsed and destroyed the startup. So like both happen, right? And so what we look for is a narrative on why. And the key concern with a solo founder is, do you not play well with others, right? Like, because you're gonna need a team, you're gonna need customers, you're gonna have to convince other investors. So if you're a problem person, that's probably not gonna work. So we're looking for evidence that there's a rationale for why the situation is the way it is, which often happens. Like I said, we've invested in multiple people in that scenario. And then also as a team, we prefer that they've worked together historically on something. Either they went to school together, they were roommates, they have some demonstrated capacity to live with each other. They didn't just meet last week, right? Or picked each other up on a Craigslist ad or something, right? It's like that there's some history together and they both understand it and they both are adding value that's different within the team. And then one of the ways that we will test for this is to look at the cap table. So the capital table demonstrates who has ownership in the company. And so we will get people that approach us and say, yeah, we're the 3 co-founders. And you look at the cap table and one of them owns 90% of the company and the other 2 split, the remaining 10%. And you're like, it doesn't seem like co-founders really. Really seems like one solo founder who hired 2 people. And so that you will get tested to sort of validate and verify if it's real or fake. And again, there can be a story why that's acceptable. 90 and 5-5 is okay, maybe. The other thing I would say is, if don't just there will be some pressure to demonstrate. You will feel like there's pressure to have a co-founder. It is the more typical path, but I wouldn't allow that pressure to let you go and get somebody and just quickly bring them in again. I think it's important that they fit. And one of the obvious ways that you can test that is you can allocate them equity, but have it vest over time. So you can say, like, look, realistically, this is my company. I founded it. I'm the one that's taking all the risk. I believe you are the CTO. You believe you're the CTO. If so, then you'll stay at least 4 years, right? We'll work together for 4 or 5 years. So let's give you your 20% equity, but you're going to get 0 for the first 12 months while we make sure that everything works. Then you're going to get 1 quarter. And then over the next 3 years, you're going to get another quarter monthly allocated or something like that. That's like fairly typical. And that's a smart thing because we've seen some issues. Like we have a startup right now that we had a call with earlier today where 2 early co-founders left and they still own like half the company together, but they do nothing. They add 0 to the company. And now it's hard to hire other people because you can't reallocate. It becomes like a nuisance to deal with. And even fundraising, people are like, why are these 2 guys on half the company? Like, who are they? What do they do today? So it's important to be thoughtful about it and kind of do the right thing and work with people that you like. And if you're going to be solo, that's okay. Own it and have a good story as to why, and surround yourself with other good people that can help you on the team. What else? One more, last one, or we're last one, I think. I'm going to go way back up here. I can't see you with the lights. It looks like you got a hat on, maybe. Yeah.
So, first of all, thank you all for being here. My question was again probably to everyone, but in terms of, so if you identified a VC who can really support you and make connections, is it the right attitude to think about having them have a big investment in you so they give you their time? Is that a good approach, or is it just how much funding you need at that point in time?
It's a good question. So the question is, let's say you find an investor that you sort of have fallen in love with. You think they're great, they're the perfect investor, they can help you a lot, and you want to work with them. Should you allocate them a larger amount of investment in your company to kind of entice them to care more, or just raise however much you want? I would love to hear other opinions, but why don't you go ahead, Lyman?
Yeah, I think getting back to Grace's point before, and I may even go back on actually saying that you should ask how much should I raise, but having like a very crisp point of view on what you're raising and what you're going to invest that in, and sticking to that, and not changing it, mid-process, mid-pitch, unless you have just a massive amount of demand and you decide to open up the round to let in more investors or other strategic investors that you think could be a fit. That's a good reason to change the amount you raise. But I wouldn't say I wouldn't change the quantum or not have a crisp point of view on the quantum of money you want to raise and what you're going to do with it going into any conversations.
Yeah, I think that's smart. I would also say that I would beware of raising too much money because it puts you in like general rule of thumb, you're going to give up about 20 to 30% ownership in the company each round. That's like generally speaking. So 20% if you're very strong and you look like you're the best in class, 30% if you're a little bit weaker and there's more questions and risk. And then, so whatever you raise, your valuation is going to be based off of, it's not exactly that algorithm, but there's some relationship there, right? So if you end up doubling the amount of money you raise, you've now doubled your valuation. The expectation to that valuation is at least eventually tied to revenue, which means then when you go to your next round, the general expectation is you roughly double your valuation at each round, unless you're on fire and you might triple or 5x it or something like that. But so if it's less than 2x it, it looks like you're kind of losing. Maybe there's something wrong, but increasingly over time, it's based on revenue. So if you can't catch up, you can put yourself in a really tough position. If you raise too much money early on, suddenly there's a lot of money that's like, dude, you got to hurry up. Like, I need you to get $50 million revenue ASAP, and you just can't deliver on that. And then you could end up having down rounds, and you get squeezed out, and then you can get pushed aside. So it is a very slippery slope, and I would say I would encourage people to raise the least amount that will reasonably get them to the goals that they want to get to, with a little bit of buffer, but not like 3x, like 20%, 30% more than what you think you absolutely need. Maybe 50%, but not. I wouldn't go overboard. I'd be careful.
I would also be incredibly intentional about who your lead or co-lead investors are, because those, to your point, will be the ones that have a bigger vested interest. They'll likely sit on the board. They'll likely help to put together the syndicate. So I think it's important to think about how you build out the round, but pay special attention to the partnership that you're developing with your lead investor. I once heard that relationship described as a marriage, which, 10 years is a long time. Hopefully most marriages last longer than that, but it's a significant amount of time. I would really do the reference calls on the lead and the co-lead, and I'd be really intentional about who you pick for that position if you are in a fortunate situation that you have multiple options.
Yeah, I agree with that. That's basically the reverse of your question, but is absolutely true, is that whoever you take the most money from, make sure you do like them, because they're going to have the most influence over you, you won't compensate with a $50,000 investor on the side is not going to have the same influence over them. So that's a great point. All right, I think we'll call it there and turn it back over to Joe. Thank you guys so much for your time. Thank you guys.